Welcome to our eSignal Weekly Forex Forecast. My name is Jay Norris. I teach trading at Trading University. As always, we need to remind you that trading involves risk of loss and is not suitable for all investors. First market we'll take a look at will be the Australian US dollar. And what did we say last week about the good possibility of sideways price action in the Aussie? And that's really what we saw. You know, we went down, price went down, the Aussie went down, tested that August low, summer low, and the low held, and now the market's bracketing, heading back higher towards the top of that range. You could see I've included a little longer term resistance in here, a band of resistance between, likely band of resistance between 50% and a little over 60% retracement level. You can see that resistance level we left in there. We talked about that last week. Well, it couldn't get above it on a daily basis, right? And so what happens if you can't get above resistance on a daily basis? Then the price is going to fail. The resistance held, so shorter term sellers take advantage of that, and that's what we saw. But you see, you couldn't press it below, you couldn't hold it below 92.50. So just as we talked about last week, you're looking at sideways price action in the Aussie. That to us spells, as shorter term traders, we're going to trade both sides of the market. I'm going to show you something really quick that tends to be supportive of the Australian dollar. It's certainly nothing new. Everybody knows about this. Remember a couple weeks ago we were talking about population pyramids, and here's the population pyramid of the United States. It breaks down the population as far as a percent of the total, and what's very positive in the U.S. is see how 20-something-year-old males make up the largest percentage of the population right now. So you have a good block of 20 to 25-year-old males, and guess what they're going to do? Eventually they're going to settle down and have families. Doesn't always seem like it with the way the Generation Y kids are, but believe me, that's something that will happen, and that's going to be a positive thing for the economy long term. We talked about that, the difference between the U.S. population pyramid and the European population pyramid, but we never did cover the Australian population pyramid. Let's break that down. Here's the Australian population pyramid. Look at how large a percentage of the people are that are working right now already in Australia. Very young working class population, so you'll have no problem as older people start to age and start to consider retiring. They will have no problem replacing those working people, replacing those consumers in the economy. So Australia has a great population pyramid. Now that doesn't certainly mean they're immune to downturns in the economy, and probably more important, I don't think it's necessarily be a downturn in the economy that would equate to a lower Australian dollar, but the Australians realizing that national pride for a strong currency aside, a weaker currency for Australia can be a really good thing for their businesses. It can really help their exporters. So I think they'll learn to play that card over time, and that's why we think that this up move, this predominant rally that the Aussie has seen, going back all the way to the beginning of the year here, that will in time weaken, and you probably will get a 100% retracement of that, and potentially lower too. Historically, when you look at the Aussie, it's still expensive, and I think not only the political leaders down under, but also the business people too will start to come to that realization that a less strong currency can be a good thing across the board for them. So that's something to keep in mind for us. But for now, Australian dollar, it looks like it's on a neutral footing still. Next market, the dollar chief. Dollar Swiss is strong. Look at it. It came right back here. I'll show you a little trick. I'm showing this to a student on the 4-hour chart last week. Okay, you take your last impulse move down. Go right to the low. And look at the down move that was created right before that low. Okay, see this last impulse move? Pops out here, right? It's 3 days down. 1, 2, 3. Big 3 down. Okay, anytime you see an impulsive move like that, it doesn't have to be 3 down. It could be 5 down. It can even be 2 down. But when you see that last impulse move down to the low, and then when that retraces by 100%, see how it was 1, 2, 3 all the way down, then it went sideways, and boom, it retraced 100% of that. Once that market retraces 100% of that, believe me, the shorts are nervous. That's a market that can resume its rally pretty easily. That's what it did. It retraced that last impulse move by 100%, went sideways, and then pow, went on to make a higher high. That's a 4-hour chart. So that's a trick that most experienced traders understand that pretty well. And here's the Swissy overall, the bigger picture. Here's the Swissy, the dollar Swiss on the daily chart, and you see a clear pattern of higher lows and higher highs. Let's take a look at the big picture, pop out to a monthly chart. And boy, there sure seems to be a lot of room on the upside of the monthly, right? Look at that. You certainly can't rule out a move to par. In fact, a move to par from here would seem pretty realistic, and that's a big move. That's over 800 pip move longer term in the dollar Swiss to upside to get to that par level. So for our money, and we've been saying this, there's a lot of room on the upside for the dollar pairs. Here's the dollar index itself. Here's the big dog itself. Look at how this market didn't even correct in here. It just went sideways. We talked about that last week, how powerful it is, and that's why I say do not get caught up in trying to play a counter trend move down here. Just maintain longs or look to add to them on smaller price dips. And that was good advice, because look at that. It just went sideways, then bam, it broke out again. So big dog dollar index making a higher high on Friday. Pretty good move. And here's another one where you have to look at the big picture here. You can't get caught up in thinking, oh, we're having bigger ranges on the daily chart, it needs to correct. It doesn't. Markets don't ever need to correct. Here's the big picture. Here's the monthly chart. Look at how much room up above on the upside we have. I mean, it'd be nothing for this market to sneeze and get up to 88, and then you'd have a historic breakout. Technically, it hasn't even it's still gone sideways. You go back 5-6 years, you get a breakout above that 88 level, and boy, you get the feeling this rally is just beginning, right? Next market is the euro, and we feel that long term. Let me scroll back down to a daily chart, that you have a lot of downside here. Europe definitely has its problems. You look at the most important fundamental, and that's people. That's your consumers. And back to that population pyramid, not to beat the dead horse here, but look at how healthy the Aussie population pyramid is. Let's go to see the European one. We'll use the German economy as a proxy for the European economy. Here's the German population pyramid. You don't have many young people coming in to the workforce to get jobs, to start families, to buy homes, to buy refrigerators and furniture for all those homes, all those good things that keep an economy humming, right? Instead, the majority of your population in Germany tends to be older people. They already tend to have homes. They already tend to have bought the refrigerators and the cars and the second homes already, right? So you don't necessarily have a lot of younger people coming up to take their place in the economy. And that's why we feel that longer term, I think you get a better look at this on a futures chart, because you have more of a price history on a futures chart. Let's look at that. The futures chart on a monthly basis. There it is. That's the euro long term. So you could see this move, this 2-year bull run finally giving way. And again, you get the feeling that run just started. Now, when you look at economic numbers in Europe, they're not getting any better. And then you realize, well, wow, look at that. You don't have the 20, 25-year-olds that you have in the U.S., and you sure don't have the young people you have in Australia. And that the European economy, the German economy, they have to compete with these other economies. You start thinking, yeah, there's a lot more room on the downside. This is a monthly euro chart. That's kind of ominous, isn't it? Let's take a look at the gold chart, the gold market next. And here's gold. There's the bigger picture. Well, the opposite. There's the long view, the big picture in gold. If you look at gold going back over the last 3 years, it's in a clear downtrend. It's in a marked downtrend the last 3 years. Now we'll back down a little bit to a weekly chart, and here's what I want you to see on the weekly chart: this pattern of lower high, lower high. Now scroll down to the daily chart, and here's what I want you to show you: this pattern of retracements. I think that's a 2/3 retracement. So the market gives a nice 2/3 retracement here. Then what happens again? Another 2/3 retracement. Okay. Now what's here? That's a lower low. Remember last week we were talking about, well, there's some diehard gold bugs. They're saying, well, gold is technically showing a pattern of higher lows. Well, yeah, that is true, right? But what did you have here? That's a lower low, right? So you have a lower low to that. So you have the pattern, definitely a longer term pattern here. Your longer term pattern is one of lower highs. Your shorter term, intermediate term pattern, again, lower highs. Now your short term pattern, lower lows. So what my point is, the short term is aligning with the intermediate and long term, and that's, you don't want to get in the way of that when the patterns evolve like that. And that's something we teach our students. And speaking of our students, we're very excited. We go back to teaching We're back from the summer break this week, the 26th. We're back. We're going to be teaching both in the U.S. evening session and the morning session. So our students that have day jobs in the U.S. will be able to attend our evening sessions also. So we look forward to that. Last market we're going to cover is the dollar yen. And no surprise, he had a big rally. And this is what we talked about, buying dips in a market where the majority of patterns are higher. And boy, you really saw the advantage of that, how when that market set that pin doji, and they're very bullish development on support too. Look at blue stops below the support, 101.50 held, and you had a heck of a rally there. And that's what we talk about. That's what we've been talking about for months in this market. Remember me saying how many times I say it, if I like it at 101, I love it at par. It's a great market to have been buying dips in. It's a great market to be playing the long side. Sure enough, you had a big rally in there last week. Thank you so much. Always a pleasure to be here with you. I'll leave you with this thought. Harmony between your thoughts and actions creates a solid trading foundation. Read that again to yourself and think about it. Harmony between your thoughts and your actions. How many times have you said you want to do something to improve your life? You want to maybe work out or eat better or do something that's going to help you, and your thoughts are there, but you're not following up with the actions. And that conflict, that's a tough thing. It's tough to be a good trader. It's tough to be good at anything really long term if you have that conflict in your life. So it's really the little things you really need to do well in life, and just the effort. Make the effort that your actions are matching your thoughts, and the same thing in trading, right? My name is Jay Norris. I teach at Trading University, and we'll see you next time.